Welcome, ladies and gentlemen, to Lesson 6, Preparing a Bank Reconciliation and Common Revenue and Inventory Journal Entries. Now, we're stepping aside from chapters 1 through 4, where we talked about sort of general business, common business transactions, and then in 5, where we're talking about the financial reporting life cycle and financial reporting process. Now we're getting into specific transactions, and the beauty of what I put together here in this cheat sheet is we're going to cover basically all of the common transactions you would see in your homework and your professor's exams. Because these are common transactions that any business would go through. Now the numbers are going to be different, but the numbers are all interchangeable and like similar concepts. You're going to see similar concepts in all the transactions, in all the problems and all the homework and all the exams. But the numbers going to be different, but the concept's going to be the same. And all you have to do is pluck out the different numbers, and that's why they call it a cheat sheet. Really, you just have to interchange the numbers, and you're going to come up with the same answer. All right. So I'm going to walk you through bank reconciliation, revenue transactions, and inventory transactions. Now let me start by asking everybody out there, do you balance your own checkbook? Does anybody out there know what balancing the checkbook is? Well, I'm an accountant, I'm a CPA, I've never balanced my checkbook in my life. But luckily for me, I only have a couple of transactions and a couple of checks that I write each month. I don't have to worry about balancing. I've got a good idea in my mind. Okay, I got this much cash, so I can take that out. Sometimes I go to the ATM and they say it's not enough money. Well, that's okay. I don't have enough money. That's my way of balancing my checkbook. Well, companies can't do that. They can't afford to do that. They have so many transactions going on that they need to balance their checkbook. And basically a bank reconciliation is balancing your checkbook. But they have so many transactions that they need to do that. In addition, they're going to find errors and also potentially fraud by going through their bank reconciliation, because the way you do it is you take all your recorded transactions. You remember lesson 2, lesson 3, lesson 4, we record all these cash transactions that happen. We buy this, we sell this, we receive cash. Well, there's no room for error in there because we're recording every transaction. Well, if somebody's stealing money, if they're taking money out of our bank account without us knowing it, it's going to come up in the bank reconciliation, because our bank reconciliation isn't going to balance. Our bank to book difference is going to be different, right? So that's why we go through the process of bank reconciliation. Luckily for me, I can monitor my bank account enough where I know if somebody's taking money out, right? Basically, nobody ever has. I don't think anybody ever will. But companies are a lot different. They got hundreds of people writing checks, different departments, different managers approving checks, different vendors. There is a definite potential that somebody could be stealing cash out of the company. So the bank reconciliation is a key, and these are things we call internal control, but it's a key control to whether or not they have fraud. So that's big picture concept. Now let's get into how we do this transaction. So we're going to be given some givens in each of these problems. All right, I'm going to go through the givens, and then we're going to go and prepare our own bank rec, and I'm going to give you some notes on how to record these common transactions that go through a bank reconciliation. All right, so the problem is prepare a September 30th bank reconciliation statement from Round Belly. The September 30th bank statement indicated a balance of $29,492. All right, while the cash general ledger at that date shows a balance of $26,300. Go back to lesson 4, go back to our adjusted trial balance, go back to our balance sheet from lesson 4. That's the balance, right? We're balancing into HMS Round Belly's cash account, right? So this rolls forward. This is how you do a bank rec. You take your cash balance for your ledger, right? Your ledger is the sum of all the general entry transactions. The ledger balance is the sum of all those. That's all our transactions, so we know that's our balance. That's what we want to balance to. The bank, on the other hand, says we have $29,492. Okay, the bank reconciliation, we need to reconcile the two. What's causing the difference? All right, now we're going to go through the rest. Now the rest of the givens. Outstanding checks totaled $3,592. A $500 check mailed to the that's A. B. A $500 check mailed to the bank for deposit had not reached the bank at the statement date. C. The bank returned a customer's non-sufficient fund check for $500 received as payment on accounts receivable. All right. D. The bank statement showed $50 interest earned during September. E. Check number 1021 for supplies expense cleared the bank for $850, but was erroneously recorded in our books as $800. And F. A $600 deposit by ABC Company was erroneously credited to our account by the bank. All right, so we're going to start this out. HMS Round Belly Inc. Bank reconciliation, September 30th, 2010. Start with the bank balance. Bank balance, September 30th. All right, include that. Down below, put a book balance. That's how we're going to start every bank rec. homework, test, start every bank rec. Bank balance, book balance. All right, now, you'll see up here in the note, when preparing a bank reconciliation, a few things to remember. This is going to be key. Deposits in transit are added to the bank balance. Outstanding checks are subtracted from the bank balance. Bank errors go against the bank balance. Recording errors go against the general ledger balance. All right, what does that mean? Well, let's walk it through. Okay, take the bank balance, deposit in transit. This would have been a deposit round belly recorded. Debit cash and say credit accounts receivable. I'm just making up that accounts receivable. But we debit cash, right? So cash increases. And we send it to the bank to deposit. Well, it hasn't gone to the bank yet. The bank doesn't know that we're depositing that check. So the bank balance doesn't include that. So we have to add it. We have to add it to the bank balance, right? Because it's included in the general ledger balance. All right? That's B. Let's go to F. We'll just go down this row here because these are all given. We're just going to go down in this order. And you'll see on your cheat sheet, we're just going to go in that order. F, 600. A $600 deposit by ABC Company was erroneously credited to our bank account. Go to the note. Bank errors go against the bank balance. This is a bank error. They took somebody else's check, put it in our account. Bank error, take it out. Take it out of the bank balance. F, $600. See? Add, and we're going to subtract these. Also, outstanding checks. This is A. We had outstanding checks of $3,592. What did I say? Remember the note. Outstanding checks are subtracted from the bank balance. Subtracted from the bank balance. Subtract this balance right here from the bank. So what we do, so to follow this right here, we got 600 plus 3,592. That equals 4,192. We take the bank balance. We add the deposit in transit. We subtract the outstanding checks and the banker. We come with a bank our reconciliation balance of 25,800. All right, let's move to the general ledger transactions. As a transaction, we're going to add and subtract from the general ledger. All right, what do we got? D, interest. Okay, the bank recorded interest. We didn't record it in our general ledger. We should have caught it in our adjusted entries. Remember lesson 4, we did it, the closing entries? We should have caught it there. We didn't. Now we need to record it. This is included in the bank balance. It's not included in our general ledger balance. We need to add it. All right, $50. Add interest. Less recording error. This is an error that we recorded incorrectly on our books. Go to the note. Errors recorded incorrectly on our books are subtracted, or depending on how it goes, or added, but it's taken into consideration in the general ledger side of the reconciliation. $50 we're going to subtract because we recorded $50 too much. We recorded for $850. Should have been only recorded for $800. We need to subtract that $50. That's E. Non-sufficient check. Or non-sufficient fund check. Well, we would have recorded the deposit, so increase cash, and say accounts receivable. Decrease accounts receivable, that's the journal entry. Increase cash. We would have increased cash, got to the bank, the customer didn't have any funds, they wouldn't have deposited it. So there's a difference. We need to add it, or subtract it from our general ledger balance because we would have recorded it, the bank wouldn't have. So in order to reconcile the two, we need to take it out. We take it out. So we add the 50, the 500, we get 550. So we take our general ledger balance, add the 50 for interest, and we subtract the two, the error, the non-sufficient check, and we get to the same. And then we reconcile, right? Our two balances reconcile. We have 25,800 here, 25,800 here. So we took the bank balance, added and subtracted some things, took the general ledger balance, added and subtracted some things, we got to the same balance. Cash reconciled. That's a cash reconciliation. Now, take it one step further, we need to record the transactions that hit the general ledger side, right? We need to record these so that it actually shows up in the general ledger, so that, like I said, you got to record every cash transaction, else there's going to be this difference, and it could be fraud. So you want to record all the transactions. We're going to take it one step further. D, debit cash, credit interest revenue, right? Increase asset, increase revenue. E, supplies expense. Well, that was an error on our part. We recorded too much, yeah, so you need to debit supplies expense because we put too much in to begin with. Debit expense, accounts receivable. Well, we need to put that accounts receivable back. That customer still owes us the money. We never got it. Put that accounts receivable back, and then we credit cash, right? We decrease cash. So go down to our T account. We would have started with the 26,300. Add the revenue, debit right here. Add the interest revenue, 50. Subtract the 550. Gets us to our ending balance in general ledger. We want that general ledger balance to be our general ledger balance. We want that, so we record the entries. All right, that's the bank rec. Now let's move on to some